Everything you always wanted to know about private equity, but were afraid to ask. This is the Issues Watch podcast. Hi, I'm Jeff Kazerman, Vice President of Government Relations at the New Jersey Society of CPAs, and welcome to the Issues Watch podcast. Our topic today is raising capital by using the little understood medium of private equity funding, which is also referred to as PE. PE funding is a mystery to many CPAs, as well as to many others in the business community. Yet PE has exploded in growth over the past 40 years, while public financing has dropped dramatically. Even CPA firm Eisner Amper recently announced that they set up an affiliated business advisory firm that's financed by PE. My guest today is Mike Lorelli, who is an expert on PE. He has worked at several PE firms, has served on at least a dozen boards of companies that receive PE capital, and he runs the consulting firm Faster Landings. Welcome, Mike.
My pleasure, Jeff, and welcome to your group.
So, Mike, please enlighten our audience with a brief overview of just what private equity is and how the various constituents participate in it.
Great. Perfect opening question, Jeff. Thank you for that opening. So, I would say that private equity operates where there are two or perhaps three constituents coming together. They've got their eyeballs on a company that they think that if they owned it and they controlled it, and they could be part of the management, that it could be generating far better returns than it is today. I'm going to quickly jump to three fast examples. One would be a company that tried to recruit me as the CEO, a New Jersey vitamin nutrition company by the name of Twin Labs. Many of you may have heard of it, given that it's
Yep,
local.
I use
110
their
million in
stuff.
revenue, 11 million in EBITDA, and you're going to hear me say EBITDA, earnings before interest, taxes, depreciation, amortization, but basically broken, going sideways. CEO was the wrong person. The four high net worth people who owned it knew that, so they wanted to find a different player. That came me. I recruited aggressively, got to know the company, got to see all the wars, all of them fixable. Now, this is a funny ending. At the end of the day, the CEO turned out to be a very good friend of one of those four people owners, and he couldn't pull the trigger on his friend. And I said, I'll tell you what,
Uh,
let me go out and shop this and see if I can get private equity backed, and I'll come in and buy it. And then I'll go fire your CEO friend. But literally, um, I say that I made a little light of it. I didn't mean to sound so coarse. But I took the idea to a bunch of private equity firms. I said, here's a broken company. It could be run a lot better. Here are the things that are broken. Here's how I would do it differently if you owned it and I ran it. We should go in and make an offer. Take these high net worth individuals out at a very good profit, and let's move on with life. We actually did do that. We made them an offer. They took our offer, shopped it to a strategic who outbid us, and that's the life of private equity. But what I'm giving is an example of maybe a mid market transaction where several parties came together. You had a seller who really wasn't sure if he was a seller, but he knew he had a management problem. You had an individual who really wanted to be a CEO on a turnaround, and you had several private equity firms that were willing to invest money in this new package. Here's one example. I know, Jeff, when we were talking the other day, you said it'd be helpful if you could also give one example that people might be familiar with. And the one I would give you there without detail would be Sealy mattress. Been around forever.
yep, yep.
We all know Sealy, right? It was privately held. KKR bought Sealy with all good intentions and did very good things with it and built it. And then the crash happened of 2008. The betting market went to heck, as did Sealy's business. The valuation went to the floor. Tempur-Pedic came in with a private equity backer, scooped up all of those Sealy shares. at next to nothing price. Now all of a sudden, Temper owned both companies. So what I'm painting for you is a scenario where the answer to Jeff's terrific question is PE is basically involved where there are two or three constituents, a buyer, a possible seller, maybe a CEO catalyst in the middle, trying to put together a transaction, but one where everybody wins.
So, Mike, let me outline my understanding and you tell me, and I'm going to do this in very simple terms if I've done it right or any corrections. So you have what's called a private equity firm, uh, which has limited partners, people who are investing in the firm. And then that firm might have, I don't know, 20, 30 people that work there, and they may have different funds that invest in different kind of industries or what have you. And then you obviously have the privately owned or publicly owned company that's not doing as well as it should, or maybe they want to sell it, or maybe they want to keep, minority ownership. And then the private equity firm or fund looks at that company, does an audit, takes a really hard look at it. And if they think it can be profitable and they can help turn it around, then they come in and lay down a lot of capital and they get equity in return. They fix the company around, get it going, expand it, and then they leave the company 5, 6 years later and everybody's got more money. Do I have that right?
That is exactly the sequence of the events. And while you didn't explicitly say it, the end result, hopefully, is that everybody won. The original 100% owner, made a nice return on his money, even though for a while he gave up a piece of the equity. The private equity firm, got a nice return. The employees, did
Right.
very well. And even the bankers, felt more comfortable that they were going to get 100 cents back on their dollar.
Right. So the original owners, if I understand you correctly, who bring in private equity, give up some of their equity, they very often, after the private equity firm leaves, they become acquire that equity and become 100% owners again.
Yes and no.
Uh,
But I would say at that point in time, 5 years has passed. It's interesting that you use the number five. I'll come back to that, or you will. Um, but at that point in time, the company's like 5, 6 times bigger. The original founder, owner, entrepreneur probably has different interests in life. He's no longer 56, he's now 64. He's got 3 kids who he could leave the business to. I would say it's not usual that he comes back in and tries to reacquire a 100% stake.
got it.
I would say that it ends up in another group's hands. And that's called the secondary, when a private equity firm sells their business to another private equity firm. We call that a
Okay.
secondary.
The company that the private equity fund invests in comes in and takes equity. The company's Twin Lab, et cetera. That company is typically called a portfolio company. Uh, Correct? And could you, if I got that right, can you just give us a little background on the term itself and anything else you think
Yeah.
that's important?
No, you have this 100% right, Jeff. So um, when we buy that company, we would refer to it as one of our portfolio companies. I'll give you another example here. When I was an operating partner with Falconhead Capital in New York, a company that we bought that maybe several people in our audience today are familiar with, given your location, Rita's Italian Ices,
Oh yeah.
headquartered in Philadelphia. We bought
Yep.
Rita's. We thought it was a real gem. Now, the reason why we bought it was we had a deal thesis. We thought this was a beautiful, brand on the East Coast, largely in 7 states: Pennsylvania, New Jersey, New York, a little bit of Pennsylvania, Maryland, Delaware, etc. Uh, but nothing on the West Coast, and there was no reason why. So part of our strategy was expand to the West Coast and also see if the brand had legs internationally. Now, the
Oh,
prior management team and owner did not believe in that kind of expansion. We were willing to take a gamble And that's the reason why we were able to put a higher valuation on the company than he was able to. But yes, once we acquired it inside Falconhead, we referred to it as one of our portfolio companies.
Okay, and did the original owners maintain equity in that, or they just said, "Here, you take it," and
He kept 2.5% as equity, and then he
okay,
had a seller's note. In effect, he gave us a loan for a piece.
okay. And so it's called a portfolio company from the perspective of the PE fund because it's part of their portfolio of companies that they're invested in, correct? Is
Right,
that
right.
okay? Um, so there's what, 17,000 portfolio companies out there or so?
The last official statistic I saw was 16,800. I
Okay,
mean,
hey, I'm pretty smart, huh? uh,
it's interesting because I contrast that number with the number of publicly traded companies in the U.S. Over 500 million in sales, which is an easy stat to pull, and that number is 3,000. So 3,000 versus smaller, admittedly, 16,800. Wow. People have
right.
no idea
I
the
didn't.
dimensions to which private equity, people just have no idea how
Nope.
big it is. They think it's a
Yep.
little pimple in the corner. No.
So what are the most common things that people get wrong about PE?
Yeah. So the number one rumor about us, which I would like to dispel, is that we're nice people. I'm only kidding. But no, but we do move fast. We do take actions. In the case of Twin Labs, had we been successful in acquiring it, yes, I would have removed the CEO. And some people would say, "All right, these guys are a bunch of butchers. They've only owned us one day, and now we've got a new CEO in here." You know, so there are going to be those undercurrents, but we got to get the job done too.
So so what are some other common
Well,
misconceptions?
we tend to be fast and then very energetic. Um, when we come into a company, we generally have a 100-day plan template, which basically says first, let's make sure we have the right strategy. And to get that set, typically we would do an offsite. We, the private equity firm, with the portfolio company management and any other outside experts that we think we might need, we do an offsite and we'd make sure we have the strategy right. Second, and this would be a more private setting, you want to make sure you got the right people on the bus. You know, what should the management team look like? Rarely is it that you're not going to make any changes. You are going to make changes, and you'll have a lot of A players, a lot of B players that can come along for the ride, but you'll have some C's that are just going to be anchors, and you just can't tolerate that if you're going to be competitive. So we'll do a 100-day plan. We'll make sure we have the right strategy. We'll buckle down and make sure we've got the right management team. If not, we'll recruit to get those fills. And then lastly, put the tactics in place and then hopefully make some music.
So I assume that typically the fund, private equity fund, has a majority or complete stake in the company so that they can just make all these decisions. Is that correct?
Yeah, I would say in the vast, vast majority of the cases, we won't buy a company unless we have control interest, which is everybody in your audience knows,
Right, right.
is 50+%.
There's been a dramatic rise in PE investment over the last 40, 50 years. Just keeps booming. Why is this happening? What's
Yeah.
driving this change from going, to the public offerings to private investment?
Yeah. Well, the PE people, this is not self-congratulatory. We're not stupid. The returns are there. If you ask anyone in the equity space, what are the returns, for equities? The S&P, the Russell, the S&P, whichever way you want to look at it, the
Right.
Dow, PE. Um, you'll see numbers from um, the 20s, which would be private equity, down into the teens for the last couple of years, in the public markets. It's truly been phenomenal. Then you've got other, high yield, ways to invest your money. So, we are at the top end. And that's one of the reasons why you see some of the really interesting people to follow, you know, like CalPERS. What percentage of CalPERS, California
That's the
teachers?
Cal, right, okay.
Yeah,
The pension
yeah.
fund, right?
Yeah, they're probably the biggest limited partner, in the United States. Um, and they devote a substantial amount of their segment of their pie to private equity. And
Wow.
guess what? Every year they increase that. And then you look at the endowments, at Yale and Harvard, and you see this in the New York Times all the time. Last year they had a 15% return. Year before was a 13. They're now increasing their allocation to private equity by 2 more points. You know, that's the heart of your question, Jeff. The returns are there. Are they guaranteed? No.
So, so in other words, more people are investing in private equity because the returns are better by what? I mean, on average, 5, 6 percentage
If you
points.
if you're comparing it to other equity
Yeah.
classes, I would say 3 to 5 is a good number to use.
Okay.
And then the fixed markets are a different animal.
Okay. And so they invest in the fund, and then they're limited partners, and they sit back and wait for their money to come in, so to speak.
Yeah.
Um, although it's a little bit riskier than just going into a mutual fund. I mean, at least theoretically, correct?
Well, not only that, Jeff. Plus, there's no liquidity. If
Oh
you
yeah,
if you want if CalPERS calls me and says they want their money out of my Rita's investment, and I was the person that pushed Rita's, I can't give them their money back. I got to wait until I
right.
sell it. You know, and
Got it.
I'm sorry, CalPERS, but I'm in year 2, and I don't think I'm going to be selling this thing for another 3.5 years. So sit tight. Cool your jets.
So when a limited partner invests with the fund, they don't just say, "Here's $2 million. Go and invest in with what you want." They'll say, "Put it in Rita's or put it in." You
Well,
follow
they
what I'm s-
typically, well, there's a little more shape here, Jeff, in that a fund will pretty well define the space they want to operate in. Is it consumer? Is it high-end consumer? Is it
Right,
luxury goods? Right? And if the limited partner, isn't comfortable with that space, well, the conversation won't go very long. But if they are, they
right,
could, probe and stuff. And in fact, we get LPs who bring us ideas of sectors and companies that we should be looking at. But, by and large, we have an eye toward a particular sector. The larger firms, I was blessed to work for Riverside for 5 years, you know, they've got 7 funds. They've
right,
got 3 funds in the US. They've got a European fund. They've got an Asian fund. They've got a materials fund, you know.
right.
So
So when they put so when an investor, a limited partner comes in, he knows he can't just ask for his money back.
no,
So
no.
okay,
He,
I got
he's
it.
got he's got to live with us through the duration.
Right.
Now, that's
Okay.
not to say that they can't turn the heat up, you know, because if an LP calls me and they say, "Hey, Mike, read us. We know you're in love with the CEO and he's doing a good job, but actually he's missed the last 3 quarters. The loan agreement says that we can. He's in violation of the covenants now. We actually can take control of the company. We're not going to do that, but I got to tell you, we're not in love with this guy." Now, if I get a phone call like that, I really have to be sensitive because when we finish this fund, hopefully with a nice gain for everybody, right? I'm going to be out with Rita's next fund. And guess whose doorbell I want to ring? CalPERS. And I
Right.
want them to be say, "Hey, Mike Lorelli and Falcon, it was good to us. Let's go into their next fund too." So I would tell you that it's a long day before you ever have a serious disagreement with an LP who picks up the phone and puts a phone call into you.
Right. Right. Okay. So, Mike, PE firms, I'm sure you know this, they need to earn a living too. We've spoken about limited partners. We've spoken about the companies themselves who invite PE firms in. But how does the private equity firm itself make its money?
Very good. So, Jeff, 2 things. First, when we go out and buy a company like Aritas, Um, and it's X million dollars is the purchase price. And we have the LPs all lined up. The day we close, we send out the announcement telling them and giving them the instructions on how to wire their share of that purchase price, which they then wire in. Once that money is in, we start billing them, all of those LPs, 2% of that amount is our management fee.
Every
Now that
year?
goes every year.
Okay.
That goes exclusively toward salaries, general overhead, the office, the rent. That's it. No frills, no bonuses, nothing. It basically just keeps the shop afloat. That's all. That's our management fee. And Jeff, you're right, it is annual. Then, when we sell Rita's, which we did in year 5, hopefully at a profit, or we wouldn't be around as a PE very long. The first thing we have to do is pay back the banks. Pay back the banks 100 cents on the dollar. Now, when the banks are paid 100 cents on the dollar, then we the PE, take 20% of the profit that's on the table and put it in our pocket, our the PE. That's the carried interest, that famous term, carried interest. I'll come back to that. After that, the money that's still left on the table, and there still better be a lot, or I wouldn't be in business,
Right.
that goes back to the LPs in proportion to how much they paid in. So think of that as the trickle down. That's the waterfall. 2% management fee. That's an ongoing piece. Next, I got to pay back the banks, get them whole. That's contractual, per all of the loan agreements. Next, I take the 20% carried interest. After that, I spread it around depending on their proportion of what their paid in percentage was of the original purchase price. Now, I come back to that carried interest thing, and I
Right.
just make a footnote because there's been a lot of debate over the years, and I'm sure everybody on this call has been, reading or at least aware of the debate. Should that be taxed as ordinary income or long-term capital gains? It's presently still long-term capital gains. Hope it stays that way. Very surprisingly, Trump came out during his campaign and said it should be ordinary income. So every year this comes up, who knows where it's eventually going to land. But for the time being, that's where it is right now. Does that answer, Jeff, your question?
Yeah, I just wanted to ask one little thing about what you just went through. So the fact that you mentioned paying back the banks and so on, uh, I assume that sometimes the private equity comes in, the company firm comes in, and they just buy it outright, or get their equity with funds they already have that they got from the limited partners, and that sometimes they also go to banks to get the money. Is that correct?
Well, I would say the majority of the cases, Jeff, because money is so cheap. You know, we will go out and buy it, but then we will take on debt.
Okay,
We'll take on
I got it.
you
Okay,
know
that makes sense. Yep, I
yeah,
didn't think of
we'll
that.
take on primary debt, at a certain interest rate, and then mez debt secondary at a higher interest rate. But we will use leverage.
Okay,
It's not
right.
used as heavily as it was originally in the earliest days of PE, but we still will. I would say that 95% of the PE deals bring in debt.
Okay,
They don't just
interesting.
pay for it
Yep,
out of their own
yep,
pocket.
makes total sense. So, Mike, do you have any last thoughts you'd like to share with our audience?
Well, I think all of you are in a great space. The functional work that you do, you're in the golden goose egg, of the planet, the New York metro area, and your next door neighbor is a private equity person.
Right, you
So
mean because there's so many firms in New York
physically,
City? Yeah,
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 yeah.
yep.
So you've got lots of reasons to take 10 minutes every once in a while and think about a lot of the questions, that Jeff has been teeing up here on this call, how you might tap into it beyond just doing the traditional audit work.
Right, right. Okay, Mike, that was great. And it's always a pleasure talking with you. And I hope we can have you on again. And thank you so much for joining us.
My pleasure, Jeff. Take care.
Thanks for listening and watching. To learn more about Mike and his company, Faster Landings, visit fasterlandings.com. To learn more about private equity and other ways to raise capital, visit our Raising Capital Knowledge Hub at njcpa.org/hub/capital.